What's up, everybody? Pablo here, and today we're diving deep into the world of financial statements. Specifically, we're talking cash flow, the lifeblood of any business. Think of it like this: a company can look profitable on paper, but if they're not generating enough cash, it's like a ticking time bomb. We're going to break down the top 10 cash flow metrics you absolutely need to know to truly understand a company's financial position. So buckle up, grab a notepad, and let's get started. First up, we've got operating cash flow, or OCF. This metric tells you how much cash a company is generating from its core business operations, the day-to-day stuff like selling products or services. A healthy OCF is vital because it shows the company can sustain itself without relying heavily on external financing. Think of it as the engine of the business. If the engine isn't running smoothly, the whole car comes to a halt. Remember, a consistently positive and growing OCF is a good sign, but it's important to compare it to previous periods and industry benchmarks. Next up is free cash flow, or FCF, and this is where things get really interesting. FCF is the cash left over after a company covers its essential capital expenditures, things like buying new equipment or upgrading facilities. This is the money that can be used for things like paying dividends, buying back stock, reducing debt, or reinvesting in the business. It's the real measure of a company's financial flexibility. The more FCF a company generates, the more options it has. Is FCF growing, shrinking, or staying flat? A consistently growing FCF is a very positive sign. Now, let's talk about cash flow from investing activities, or CFI. This metric tells you how much cash a company is spending on investments in long-term assets. These investments can include things like buying property, plant and equipment, PP&E, acquiring other companies, or investing in securities. Think of it like planting seeds for the future growth of the company. A negative CFI isn't necessarily a bad thing. In fact, it often indicates that a company is investing in its future growth. It's important to analyze CFI in conjunction with other metrics, particularly operating cash flow and free cash flow. Chapter 4. Cash flow from financing. The money shuffle. Cash flow from financing activities, often referred to as CFF, shows the movement of cash between a company and its owners and creditors. This includes things like issuing or repurchasing stock, taking on or paying down debt, and paying dividends. Positive CFF can indicate that the company is raising capital through debt or equity, which can be used for investments or to cover operating expenses. However, relying too heavily on external financing can be risky, especially if the company's operating cash flow is weak. Chapter 5. Net change in cash. The bottom line. The net change in cash is simply the overall change in a company's cash balance from one period to the next. It's the sum of cash flows from operating, investing, and financing activities. A positive net change in cash is generally a good sign, indicating that the company is generating more cash than it's using. However, it's important to understand the sources and uses of that cash. Chapter 6. Cash flow, margin, efficiency in action. The cash flow margin measures how effectively a company converts its sales into cash. It's calculated by dividing operating cash flow by revenue. A higher margin indicates that the company is efficiently generating cash from its sales. This is a key indicator of profitability and financial health. Cash flow, per share or CFPS, is a metric that shows the operating cash flow generated per outstanding share of common stock. It's calculated by dividing operating cash flow by the weighted average number of shares outstanding. A higher CFPS is generally considered a positive sign, as it suggests that the company is generating more cash for each share held by investors. However, it's important to remember that CFPS can be manipulated by changes in the number of shares outstanding. Chapter 8. Cash Flow Adequacy Ratio. Covering your bases. The cash flow adequacy ratio measures a company's ability to meet its short-term liabilities with its operating cash flow. It's calculated by dividing operating cash flow by current liabilities. A ratio of 1 or higher is generally considered healthy, indicating that the company is generating enough cash from its operations to meet its short-term obligations. Always compare the ratio to industry averages and the company's historical performance to get a better understanding of its significance. Chapter 9. Cash Flow Return on Investment. Getting your money's worth. Cash flow return on investment, or CFROI, measures the return generated on investments based on cash flow. It's calculated by dividing operating cash flow by the company's invested capital. This metric helps investors evaluate how effectively a company is using its investments to generate cash. A higher CFROI indicates that the company is generating a strong return on its investments. If CFROI is significantly higher than the cost of capital, it suggests that the company is creating value for shareholders. Chapter 10. Cash Flow Coverage Ratio. Handling your debt. This metric measures a company's ability to cover its debt obligations with its operating cash flow. It is calculated by dividing operating cash flow by total debt. This ratio provides a quick snapshot of a company's ability to service its debt and is a crucial indicator of financial health. A higher ratio is better, indicating that the company is generating enough cash to comfortably meet its debt payments. Always compare the ratio to industry averages and the company's historical performance to get a better understanding of its significance. So, there you have it. We've covered the 10 essential cash flow metrics you need to know to analyze financial statements effectively. From operating cash flow to cash flow coverage ratio, understanding these metrics gives you a powerful toolkit for evaluating a company's financial health and making informed investment decisions. Remember, these metrics are interconnected, so always look at the bigger picture. Thank you so much for watching. If you found this video helpful, please give it a thumbs up, leave a comment below with your thoughts, and subscribe to the channel for more valuable financial insights. Until next time, keep learning, keep growing, and keep crushing it.